All right, good afternoon and welcome to the second Risk Research Supergrowth Multibaggers video presentation. This is our weekly report for March 20th. So we focus on the 50 highest quality growth companies in America. Our slogan, fact, not conjecture, highest quality in terms of rate of growth, profitability, and low debt. It's difficult to accomplish low debt and high growth because growth typically involves investments in infrastructure, production facilities, hiring new people, inventory. Only companies with exceptional franchises and protective moats are able to accomplish high rates of growth for a prolonged period with minimal or no debt. So we'll start taking a quick look at the market. We assess the risk in the current market as fairly high, which translates into new purchases at 3% of portfolio. This calculation or determination is based on the proximity of the current stock price to our artificial intelligence algo indicated buy at and sell at prices of both the S&P 500 and the 50 fastest growing low debt, highly profitable companies trading on US exchanges. So for instance, right now, the S&P is trading at 389.13. The indicated buy at price 362 is 6.8% below the current price, and the indicated sell at 418 is slightly closer to the current market, generating this fairly high rating on the current market. Typically here, we'll take a quick look here. This might be a helpful explanation. So we use pattern recognition software that we've developed that looks for relationships to simple moving average, detects patterns, and makes buy-sell decisions based on the recurring patterns that it sees. So of course, this means that it's volatility adjusted. That is, the higher the volatility, the more it'll drop its bid, and the lower the volatility, the higher the bid will be. This is not a great illustration, but it's helpful just for explanation purposes. So this is a simple moving average. We're using very precise numbers down to a fraction of 1%, but just to give you an idea, the algo looks for dips below the simple moving average and recurring patterns, and it will buy when it sees a dip that repeats, and it'll sell when it sees a rise and then fall that repeats. And it looks at the last 12 months of daily, hourly, open, close, and makes its determinations that way. So getting back again to the SPY algo, where was it? Right here. Okay. So what we see here is a current buy at down here of 362.56, sell at 412. The current market there somewhere in between, slightly or somewhat closer to the sell at than to the buy at. And these are the algo determined buys earlier in the year. Or earlier in 2020, started to buy as the February-March decline due to COVID started to gain momentum. It bought, sold on a bounce, bought, continued buying all the way down to the bottom, and then started to sell as the market recovered, and it was done selling in early April. Bought again late April, sold in early May, bought again, I'm sorry, sold 2 final times to clear out the last of its positions accumulated down here in December and January of this year. Okay, so now getting back to individual stocks, the most highly rated stock in the 50 top performing growth stocks right now happens to be Advanced Micro Devices and a semiconductor manufacturing company. We'll first, I guess, take a look at how we determine fastest growing, highest quality growth stock, and we'll take a look at the 11-page report that we generate on all of the companies that we follow. And we tend to run these at least once a week, sometimes 2 or 3 times a week. It's an 11-page report on financial statement trends. Most of what we do emphasizes free cash flow as reported, as opposed to reported GAAP earnings. We're looking for companies that generate a lot of cash, and we're less interested in earnings, although it does play a small role in our analysis. Revenues, you see, as these companies often get past a point of efficiency or gather momentum and achieve economies of scale, their free cash flow grows much more rapidly than do their revenues. And this started to happen for AMD roughly a year or so ago, and you can see the rise in free cash flow is dramatic. This is reflected in a declining debt trend. The red line here is dividends not applicable in the case of AMD. This chart looks at the long-term free cash flow, and the top one is return on assets. And you see, after a period of, sharp cash losses, smaller cash losses, and now we see significant, and the first time ever really, growth in free cash flow. Down here, we look at intrinsic value versus current stock price. And this company has always traded at a premium to our estimate of intrinsic value. And we don't avoid companies just because they trade at a premium. We're looking more at the overall growth in intrinsic value as a sign of quality. We look at consistency, and here, of course, you see an inconsistency, and that's definitely a negative, but not overwhelming relative to the other characteristics of the company. And then down here, we look at return on assets, which is comprised of margins and asset turnover. You see here a company who's now able to charge higher margins than they have in the past, and and we see fairly stable, although somewhat erratic asset turnover, or revenues divided by assets. So what I see when I look at this, I'm looking particularly at this middle graph here. That dotted line is the return on assets trend averaging out. It's like a simple moving average of profitability, and you see steady. It's definitely improving over time. 12 months return on assets by free cash flow, 20%. Roughly the same as the average super growth multi-bagger. Latest 12-month change, though, up almost 200% versus 40% for the average super growth multi-bagger, and negative 10% for the average U.S. public company. And 10-year average 4.8 for all public companies, 12.6 for super growth multi-baggers and the substandard AMD. So it's a company that, because of required investment in plant and equipment to continually improve their production and their quality and their innovation in semiconductors, hasn't generated much cash, but is now starting to. Down here, we look at quality of earnings, and basically we're looking at debt trends, capital expenditure trends versus free cash flow. And again, you see fairly favorable trends, mostly in the declining debt. The capital expenditures have roughly paralleled free cash flow. Profitability essentially just confirms all of the points raised earlier. Financial strength, pretty consistent improvement. Get into that more in just a moment. Intrinsic value versus stock price. Again, companies trading at a premium to our estimate, about a 33% premium to our estimated value, but intrinsic growth has been growing at an average of 151% a year, which is, obviously exceptional. And down here, this is the summary chart. When we publish reports on all super growth multi-baggers, they appear in order of profitability, growth, and financial strength trends. As I mentioned earlier, AMD is the #1 performer in terms of financial performance. I like to particularly look at this middle graph. It's taken me a number of years of working with this data to understand the significance of that middle graph. Top one's free cash flow and return on assets. Bottom one is intrinsic value and stock price. This middle one is mostly balance sheet strength. It does include some income statement items like interest coverage by free cash flow, but in any event, the real significance of it is companies that show strong long-term sustainable improvements in their balance sheet typically outperform by a wide margin the average company over the next 4 quarters. Okay, so that takes care of AMD, Advanced Micro Devices. Take a quick look at the company that's trading closest to our algo indicated buy-at price, but it's not that close. It's 9% above Regeneron Pharmaceuticals. And we'll take a look, I guess, first at the company's, we'll just whip through the financial statement trends. And here we see free cash flow and return on assets. 5-year trend, strong revenue, strong free cash flow. Of course, this is a drug company. Here we see dividends, free cash flow, doesn't pay a dividend. Long-term trend. Intrinsic value much higher than the current stock price. And this is common with pharmaceuticals. They're way underperforming in the market right now, and that has attracted our special attention. Looking here at return on assets, see declining asset turnover, improving margins, and as a result, we see strong return on asset trend. No debt. Profitability trends substantiate the other. Financial strength trends substantiate the other conclusions. Again, price to net asset value. We're saying that it's trading at half of our estimated intrinsic value. And then here we look at free cash flow. We look at financial strength that's deteriorated over the last couple of years, but has recently stabilized. And that gives us the conclusion, financial strength, exceptional, trend neutral. Down here, below average risk, exceptional upside potential. Statement trends overall are positive. Margin trends slightly positive. 2-year financial trends exceptionally strong. We'll go back and look at the company selling close to our estimated sell at value, which is Autohome. Well, first, I guess we'll take a quick look, at Regeneron's algo-generated buy-at and sell-at level and the trends. So the algo-generated buy signals here in February of last year Stock bounced pretty quickly and it generated sell signals, began to accumulate a gain in March, sold in April and May, other than one sale here early in March. A lot of this was COVID related, stock price action. The algo bought again on a sharp decline, sold again a few days later on a sharp improvement. Hasn't done any buying or selling now for several months, since mid-year last year. And it's indicated buy at level right now, 445.71 versus a current stock price of $473. So buy out of 442, sell out of 527, current stock price 473. Take a look at that again for a moment. 445.71 versus what I said a moment ago, 442.93. This algo updates about every 8 minutes throughout the market trading day. And so why there's a slight discrepancy is just that the time I prepared the chart versus the time I prepared this little table down here, the stock had moved a little and the algo had picked up on slightly different patterns. Okay, Autohome, company trading at the company trading closest to our indicated sell at level. This is if I was to prepare a weekly or monthly or quarterly report, and maybe I will, on mistakes made and what I've learned. I really believe that in the market, if you're not constantly learning and looking at your positions and looking at your investments or shorter term positions and not learning from what's going on, then you're at a distinct disadvantage. And I took a number of positions a couple months ago that were based solely on the algo and on the stock and the fact that these companies were in the portfolios of leading growth managers. And here this is our portfolio report that's updated throughout the day, every 8 minutes. I ran it. It doesn't run on the weekends, but I ran it in preparation for this a few minutes ago. And there you see Autohome right there. Current price of 100, indicated sell at price of 106.53. And this company was in the portfolio of one of the top 10 growth funds we monitor closely positions in all the portfolios of the top 10 funds over the last 10 years. And Autohome happened to be in that group. So this is the summary report. And the way you find a company in there is you type in the stock symbol. Trying to see where there we go. Okay, here it is, and then you just click on the symbol in the top left corner of the summary report, and it takes you to the 11-page report. You see a company with no free cash flow, strong revenue growth, strong but volatile. Free cash flow generated substantial free cash flow in 2013 to 15, but has not since then. We're estimating as a result it has no intrinsic value. Anyway, getting back to what I started to say a moment ago, that mistakes made. One of the things that we do really well is that not many investors are put the time and thought into, and many don't even understand financial statements is the financial statement trends. And so that's one of our advantages. And we should be focusing on that and not buying stocks that show up as with negative trends just because they happen to be in the portfolio of a highly successful long-term investor. So like here's Autohome is the number one position in the portfolio of the number one small cap growth manager. But that shouldn't be enough. I regret taking this position. So I'm just looking for an opportunity to get out. And so here, if we look at Autohome, we see the buys and the sells as indicated by the algorithm, and we see that it's it bought, sold at a good profit. A few days later, bought, sold again at a good profit. But looking at these recurring trends, the algo determined that this was a buy point here after this sharp decline. And it's in fact continued to decline. So our average purchases here were at $107, and the market is now, and the algo is now saying sell out at $106.53, which would obviously be a slight loss, 75 cents a share. And that's not a lot of money. And we're not going to buy at, that it says buy at, but it doesn't matter if it declines to that level. We're done with this stock. We're just looking for an opportunity to get out. In the last day, this is a daily chart. It performed, it bounced quite a bit. We're looking forward to an opportunity to get out up here around 106, and that will be a slight loss for us. All right, well, that's about it for this week, and thank you for taking the time to listen. Bye for now.